$573 billion, 6,652 projects, over 1.6 billion square feet. That's the size of the active construction pipeline right now in Canada. And the question that every developer, investor, and every builder is asking is, does any of it pencil?
A 60-story condo tower in Toronto costs up to $480 a square foot just to build the shell. And that's before you touch land, before you touch soft costs, before a single development charge. Presale prices are down over 13% from peak. I think, there's the worst month for price drops that we've ever seen in pre-construction history happened in the last month. I'll pull up a chart on that in a second. And, a lot of that's the HST kind of getting repriced in, but project cancellations as a result of this hit a record high last year. And by the end of the decade, Urbanation says virtually no new condos will be delivered in the GTA. We are seeing a little bit of a resurgence of purpose-built rental demand, which I'll also pull up. And I think that the people talking about how the supply shortage could evolve, that thesis might go away as a result of purpose-built rental. I know you work a lot in that space, but we'll get into it today in today's episode. But the moral of the story here is that something has to give.
Yeah, completely agree. And, Dan, great point. I think that supply is just going to look a lot different than what people are used to, right? Condos aren't going to be the thing anymore. Purpose-built rental is, at least in the foreseeable future. On that note, welcome back to the Canadian Real Estate Investor Podcast. I'm Nick Hill, joined every Tuesday and Friday by Daniel Foch. And today we're going to be cracking open the Altus Cost Guide, the Canadian Cost Guide. This is kind of like the industry benchmark for what it actually costs to put a building together and kind of like get it out of the ground across the country. We're going to walk through the numbers, kind of layer in some real world context, of course, tariffs, labor shortages, development charges, one of the usual suspects of making things not pencil. And of course, it all comes down to the feasibility math, right? Does this stuff pencil? And we're going to tell you what this means for investors and developers in kind of the latter half of 2026 and what this likely looks like for next year and moving forward.
Yeah, and we're not just going to be talking about Altus's cost guide in isolation. We're going to bring in a couple of other things like CBRE's outlook that we broke down a few weeks ago and look at why condo projects are getting canceled at record rates. We're going to run through the $343 billion infrastructure pipeline that's reshaping the labor market, which is a lot of that government spending, that make work recession project theme that we've been talking about, which is keeping a lot of this construction labor employed and keeping costs relatively elevated. And we're going to answer the big question, which is, where can you actually still build profitably in Canada right now?
Lots of great questions, lots to get through, Dan. Let's get into it. Okay, so let's set the stage here to start things off. The Altus Guide opens with something that sounds familiar from our CBRE episode and from a couple other episodes, and that is the word uncertainty, right? Seems to be one of the buzzwords over the last couple of years. Certainly the sentiment has been uncertain, which is kind of the invisible hand that moves the economy. And that's no secret, because between 2024 and 2025, it seems like a long time ago for some, but we all remember the high interest rates, persistent inflation. We covered all this stuff on the show. Supply chain constraints that slowed private residential and commercial development across the country because you couldn't get the materials or they were so overpriced. And the industry wasn't recovering so much as recalibrating, right? Like it's getting used to those new costs and kind of the new world that we're living in and setting that as the baseline from there.
And that new baseline is sort of the key phrase that they're leaning on in this report, where they talk a lot about construction cost escalation and where it comes in between 1% and 2% in 2025, which is way down from the wild swings that we've documented on this show and a lot of people saw in the pandemic era and then 2022 and 2023. Turner and Townsend is projecting bid price escalation of 1.5 to 2.5% for 2026, so below inflation. So real GDP growth, let's call it, of the construction space is actually not positive. It would be negative relative to inflation. So your costs have stabilized, but they've stabilized at a high level. They haven't come down as much as most people would want them to. I am hearing, I don't know about you, but hearing about contractors getting bids that are below what they were seeing at the peak, but it hasn't really materialized in broad improvement in total creation costs across the entire market, I don't think.
Yeah, it's funny. I was out for lunch with some developers yesterday, and of course, this the subject of labor pricing and material pricing came up, and they basically said that some materials have gone down, some have kind of stayed the same, some materials have actually gone up, and it's been kind of the same for labor. You've seen some trades that are, have a bit more spare time, which they had a couple more jobs, but some of them still haven't lowered their prices. It hasn't really, that baseline hasn't set in for some of these, from some of the actual trade and construction material prices. And, in the report, Altus actually makes another important caveat, Dan, like on top of yours, that their 2026 guide doesn't account for the impact of tariffs and future tariffs, right? And that's a pretty big asterisk. Steel, aluminum, a lot of the kind of manufactured components that go into larger buildings, maybe not the duplexes and stuff that, a lot of our audience is buying, but we're not talking about duplexes in this episode, right? This is large infrastructure, condo projects, that kind of stuff. And a lot of those materials are subject to a lot of tariff volatility. And the numbers in this guide are essentially kind of like the before tariffs picture. So keep that in mind, that this might actually be potentially worse than what Altus is actually reporting here.
Yeah, let's lean in on that for a second, because there's a couple of pieces. Canada's counter tariffs, but also U.S. tariffs and the impact on demand. Like, I don't know if it's still this way, but I remember a couple of the condo developers that I was working with over the last few years. There was like a period last year when the tariffs first started that it actually made more sense for concrete companies in Canada to take their materials to the U.S. because the U.S.
Man.
companies, because they could be more competitive in those markets. And then you go back, you have Canada slapping this like 25% global tariff on imported steel derivative projects effective December 2025. There were tariff remissions on U.S. steel imports that were temporarily extended to January 2026 and aluminum to June 2026. But this is like, we talk about the word volatility. We mentioned how the report has the word uncertainty a bunch of times, and it's like they switch it on, they switch it off. It's like, how do you do business in an environment that is constantly, the variables are constantly changing? And this is true of real estate investing in Canada, I would say, at large. Like, you have Airbnbs are allowed, then they're not. Then you have foreign students are $1 million a year, and then they're gone. And, the
interest rates are low for a long time, and
yeah,
then they get the most aggressive hiking cycle in Canadian history.
Even with like multiplex and missing middle policy, like you get Calgary upzones the entire city, and then they walk it back, or we're gonna upzone and then we don't, or this, a lot of the CMHC changes that happen where you start your process and then the goalposts move by closing. Like, I think that you just have to be really good at pivoting or adapting your strategy to be successful in this industry right now. But output at Canadian aluminum producers was down nearly 20% year over year by the end of 2025, and iron and steel mill output dropped 4.3%. So real economic damage happening as a result of the tariff and trade war stuff that we're seeing going on.
Yeah, I mean, it's the real stuff like that is tangible, and then it's the uncertainty that you mentioned as well that kind of compiles on that and just creates a not so great situation, right? And even on the construction side, like I was mentioning with those developers that we've been talking to, Dan, some of the manufacturers that they get their materials from have seen cost reductions up to almost 8% from the tariff relief on some of these selected imports that are necessary for things like building a pipeline or cutting down trees or fresh water or any of the kind of bigger stuff that we should be doing here. But the net effect is more volatility in pricing than availability of this stuff, right? So when you're trying to budget a project 18 months out, to your point, Dan, right, with all the changes and even just with bonds and CMHC and everything like that, it can become a nightmare. Like, you kind of have to be consistently reworking your numbers, and you've got to be prepared for multiple different exits that all should be modeled out before you get into it. So anyways, with that being said, let's actually dive into the cost guide here. This is based on real project data that Altus collected, $573 billion across 6,652 projects, 1.6 billion square feet. Those are pretty huge numbers, right? That all sounds pretty good. Residential accounts for about $218 billion of that. ICI, which stands for industrial, commercial, and investment, that's about 155 billion. And infrastructure projects, so like the really big stuff, that's about 200 billion. These are the hard construction costs per square foot broken out in building type, typology, and then, we'll get into like the cities as well.
So I guess you would want to start with what most of our listeners actually care about, which is the residential side of things. Condos, especially, very popular topic, but also apartments. I mentioned the chart from Ben Rabideau that shows rental has surpassed condo as the primary type of dwelling that we're building in Canada right now. And even in places like Toronto, where we're hearing about how condos are going to drop off completely, we're seeing actually record purpose-built rental housing starts and
Yeah.
permits taking place. So if you're building a mid-rise, say like up to 12 stories, you're looking at $300 to $400 a square foot in Vancouver, $305 to $375 in Calgary, and Edmonton about the same as Calgary, $245 to $375 in the GTA, and $260 to $320 in Ottawa.
Dan, the crazy thing about the chart that you've got up right now is look where single family is compared to
I
condo and
know,
purpose built
yeah.
rental.
I mean, it's been a
Man.
flat
Like,
line forever, and people are really starting
it's
to talk about this because
yeah,
when we talk, we have an episode. I don't know if it'll be before or after this one, but with James from CD Howe, where basically, they mention we're building the wrong type of supply in Canada, right? Like Canadians want detached houses, and we're building either condos, like apartment style, or rental. And a lot of this is due to land issues. So, the basically just the way we zone land. And missing middle is a big part of trying to find the middle, the middle ground of, okay, well, we can't have cities that are only offering massive high-rise towers. But your average buyer can't afford a single-family detached McMansion in an urban area, walkable to transit. What can we give them that can get them on the housing ladder, or give them a place where they can maybe start a family? Well, multiplexes seems to be the only viable option that's getting people out of these massive towers that are full of
yeah.
yeah. So yeah, I think it's interesting. Like
I mean,
totally,
you're right. It kind of is. It's kind of that perfect blend between the three of them, right? Like you have some of the amenities of a condo. You are in what looks like to be a single family home, at least maybe from the outsider has that kind of feel to it. You're in a neighborhood, and at the same time, it's most likely a rental unless you've bought it as a condominium kind of thing. So
yeah.
it is that blend. But yeah, to your point, I mean, the taller you go, the more expensive you get, right? A 40 to 60 story tower. And there's a lot of those now in the GTA, a lot of them in Vancouver and Calgary, right? We're building taller buildings. I just saw Vancouver got greenlit for what will be the tallest tower on the West Coast. It gets more expensive, right? So 40 to 60 tower in Vancouver, it's going to run you about $350 to $475 a square foot. GTA, $320 to $450. And if you're going that 60 plus stories, you're going for, I guess that might be considered kind of a super tall, which is becoming again more common in Toronto, right? With one pinnacle, one bloor, and the other one bloor. You're going to be even more expensive than that, up to potentially $350 to almost $500 a square foot. Vancouver, they don't even have data on it because there's not enough data points out there because there's not enough of those super tall buildings.
Yeah, and I like this is obviously our vision behind the whole multiplex, like leaning into that space. I mean, we made the call a couple of years ago. We bet our entire business on it. We both trade in that space actively. You finance these deals, I buy and sell these deals and do lease ups for people. I help people execute these transactions mostly in the Greater Toronto area, but all across the country as well. And this is why we also built an events platform around it, and why we have our multiplex event in Toronto coming up on September 15th, which I think early birds will be gone by the time you hear this episode, but make sure you get your tickets because it's going to sell out. This is why we did the same event in Vancouver and Edmonton and Montreal later this year, and Vancouver and Edmonton earlier this year. And we're going to repeat the same process over and over. Why? Because as you go down in size, which you can see, wood framed residential dimensional lumber is far cheaper on a buildable per square foot basis than building out of these massive, steel and concrete structures.
Steel, yeah,
And
for sure.
yeah, you pay a little bit of a premium on a per square foot basis on land, but the other thing that you're not exposed to is the projects only take a year. So I think, right, a year for a multiplex is probably what you're seeing for your guys who are building.
Yeah,
two,
I mean,
maybe.
maybe from start, like, hey, I want to do this, to finding the land to leased up, stabilize, maybe CMHC takeout, that whole process. A year would be ambitious. I'd probably say maybe 18 months. But yeah, I mean,
But
like
not
your
6
sub.
years.
No,
Right.
you're sub 2 years to get this
Yeah.
stuff done. Outside of any like brutal zoning issues or something like that, which obviously can happen. We know we just had Ryan and Madison from Reside Properties on here, and they were saying they had to wait 18 months, which is just absolutely ridiculous. Project should have been done at that point, but yeah, the timeline between this and a 40 to 60 story condo is
Yeah.
laughable, right?
And what happens during that period of time, like when we're talking about earlier in the episode, we referenced like all that during a, like I wouldn't want to be in a 6 month or 6 month business operation in an environment that is this volatile, where interest rates can jump up and down, immigration can jump up and down. I mean, a lot of the macro inputs that I would rely on for my model could be completely different by the time I finish my project, which is what a lot of
Totally.
the condo builders are facing right now, and what a lot of even purpose-built rental operators are facing right now with falling rents and decreasing demand and increasing vacancy, even with higher rates than they originally anticipated because the
Yeah.
bond yield curve is pushed up between day one and year six when your project's completed, if it's that big of a project. So
Think
you,
about what's
so
happened in the last 6 years, right? Like
yeah,
the
yeah,
volatility,
exactly,
like it's
exactly,
crazy. It's too
yeah.
much.
So, so the smaller your project, the more you can shrink your market risk, and that agility is highly valuable right now, which is why we're seeing more sophisticated large investors get into smaller formats, maybe not multiplex, but like small mid-rise, because they want the agility and they want to get off the roller coaster, and this is the only way to do it right now until the macro environment becomes more predictable. So that's like part one that people miss. The other thing that I think people miss when we're talking about this and total creation costs is that this is hard costs only. That's your building, foundation, structure, mechanical, electrical. It doesn't include land, which, land is like what, 10% of your total cost structure, maybe, $100 a buildable square foot in the city of Toronto. It doesn't include development charges, which is a huge component of costs and, being addressed by the government, which we've talked about ad nauseum on the show about how was a necessary thing. It doesn't contemplate your soft costs, right? Architectural, engineering fees, permitting applications, all of the interest financing costs that you pay from when you took possession of the land to your land debt to your construction debt doesn't include your marketing, your legal, your real estate commissions, taxes, HST, none of those things. Those things are all on top of the number that we just mentioned. So I always think it's funny, right? Because people want to lean on the greedy developer narrative, but like they're not really, I mean, they're taking on a ton of risk and the margins are very thin. Yeah, I would say that like comparing how much developers have had to bring unit costs down to meet the market and still not being able to sell. Like there's no bid even on projects that are priced incredibly well. The sort of academic exercise of the cost report tells us, okay, well, we know what their costs are and we can infer what their total creation costs are. On top of that, developers have been running into the math that we just ran as well. And so the result is that they are canceling, at least they're canceling the former type of way that we would deliver housing in Canada, which is condo, pre-sale condos, and then you spend 6 years delivering the project and deliver those completed units to the original pre-construction purchasers. And so, you've had this wave of project cancellations. I think it's been like several years in a row where we've seen record number of cancellations in the Greater Toronto Area and across the country.
Yeah, I mean, look, just even last year alone, back in 25, a record 28. These are active condo projects, okay? Like, this wasn't like, hey, like, I plan to do this in a few years. These were people that had done all of the pre-work, the front loading of the work, site ready, all this stuff, like an insane amount of work and money spent up to this point, only for 28 of them to cancel their projects. Dan, that totaled almost 7,250 units that were canceled in the GTA alone. That's more than double what canceled the year before in 2024, and well above the previous record, like well above the previous record that happened back in 2018, which we had a little blip in the market back then too. And look, new condo sales in the GTHA fell for the fourth consecutive year, plunging 60% from 2024 to just 1,600 units. That is the lowest annual total since the year that you were born, 1991.
Yeah. So we sold fewer new condos last year than we did 35 years ago when the population was 15% smaller, maybe even more than that. Like
Yeah,
massively. I mean, maybe it was like 25% smaller. I think our population was like 30 million people back then.
it's crazy,
So,
dude. Wow.
yeah. So per capita, if you really want to examine this, number of sales per person in Canada is like massively lower than the 1990s.
Yeah, and look, that's not just here in Toronto and Vancouver. Condo starts also fell 13% in the first half of last year. Projects that couldn't hit that 70%. And we've done episodes on like how condos get built. And if you listen to that, or if you know anything about this side of the business, you know that developers need to sell pre-sale 70% of their units in order to get funding, get financing. And they didn't. So a lot of them, they lost their financing, got paused or canceled outright. And of course, the viability of those projects was just increasingly under more and more strain, and the developers are under more and more stress.
And the piece that I think people should actually want to pay attention to when you're evaluating this is that completions are expected to fall to around 22,000 units in 2026 in the GTA, that is, and then 14,000 in 2027. And by 2029, Urbanation says virtually no new condos will be delivered in the GTHA. And
So from
I
like
mentioned,
22,000 to 14,000 to like pretty much zero, or like less
yeah,
than 1,000. Like,
yeah, and
wow.
condo. So I think it's easy to look at this and say like, oh, we're going to see another bull run because population growth will resume in 2028 and there will be no supply created. But the reality is that the market is still trying to figure out other ways to deliver supply, and that comes with purpose-built rental, which I showed the chart from Ben Rabideau. I'll pull it back up, but of your purpose-built rental supply or purpose-built rental starts in Toronto actually hitting highs again. And so I don't know if the bull thesis for that is as strong as you might hope, but we are clearly watching at least the future condo supply pipeline get shut off in real time.
Yeah, and I mean, look, connect the dots here, right? Costs are high and seemingly sticky. Pre-sale prices been falling pretty heavily. Projects are getting canceled. Sentiment is off. Pipelines drying up, and Canada still has a structural housing shortage, right? It's kind of ironic that we're not building what we need, but we're just building it differently, right? Purposeful rentals versus condos. And at some point, the supply crunch is going to meet that rising demand, and prices are going to have to move. The question just is when, right? The question's about timing.
And the development charges piece makes it quite a bit worse. Like Toronto's average condo faces about $130,000 in development charges per unit, ranging from $53,000 for a bachelor to $138,000 for a house. Now, there has been some changes, and we actually had a discussion with the city yesterday about potentially discussing these and engaging with stakeholders in the missing middle space and multiplex space about these changes on multiplex units, like up to 7 units. So 6+1, you can get no development charges. And then there are deferral programs for purpose-built rentals where you basically pay them out over the entire course. So things are getting a little bit better, and council also froze the annual indexing, I think, for 25 and 26. So these things help at the margin, but the base level is enormous and has been preventing projects to date, and projects are still not getting done. So, what else is there that you need to be looking at?
Yeah, man. I mean, look, obviously that's the high end, but $130,000 per unit is absolutely insane. Yeah, we're not going to get into DCs right now because it's an evolving story that we've been covering. And again, going back to what we were saying at the top of the show, how do you plan for the unplannable when this stuff changes all the time? There has been some positive movement on development charges after the industry has just been in outrage for years now, so that's good to see. But I think there's still a lot of work that needs to be done on that side of things. So let's move on, Dan. Let's talk about like Altus. They did a city by city breakdown here, and I love doing this because I love talking about every beautiful city that we've been able to visit across the country here and giving places shout outs. So let's do a little city by city breakdown. Let's make it a quick tour. Start me off on the West Coast here.
So Vancouver is the most expensive market in the country across almost every category. A 13 to 39 story condo tower. It shouldn't surprise anybody. I mean, logistically, it's a difficult city to build in, right? It's tight. It's on an island.
Mountains, ocean, all that good stuff.
Yeah, but you go to your 13 to 39 story condo tower, $340 to $435 a foot. Class A office building, 5 to 30 stories, 345 to 425. Distribution facility is 200 to 485. Even a warehouse is 120 to 200. So Vancouver's labor costs, their seismic requirements, which is not a non-issue, like earthquakes, etc. You have to spend a little bit more to make buildings a bit more resilient, and then also the regulatory environment all push costs quite a bit higher.
Yeah, I mean, growing up in Vancouver, like the earthquakes were no joke. I remember we literally had earthquake kits and we had like practice, we'd have to like get under the desk and stuff. So real concern there, something that builders there have to deal with, not so much here in Ontario and across the rest of the country. But speaking of the rest of the country, let's head a little east from Vancouver over to Calgary and Edmonton, which are, of course, consistently cheaper, about 15 to 25% cheaper than building stuff in Vancouver. That's at least on hard cost. The same condo tower would be about $315 to $385. That's compared to like the $350 to $450 in Vancouver. Class A office, about $280 to $395 buildable. And there's the one that kind of jumps off the page to me here is building a warehouse, right? Like an industrial facility in Calgary, 130 to 175 versus that 120 to 200. Industrial is where Calgary's cost advantage kind of shines. And they do have a huge warehouse and shipping business that runs out of Calgary. So it's good to see that.
Yeah, if you jump over the Greater Toronto area, it sort of sits in the middle of those markets. Condos up to 12 stories are $240 to $375 a foot. We go to 40 to 60 stories and you're at $320 to $410. And what's interesting is that the GTA is actually cheaper than Vancouver for most building types, but more expensive than Calgary. It's sort of the middle of the market for Canadian construction costs. But, your per square foot values in Toronto actually during, kind of peak craziness were, I think, equivalent to, if not even maybe more than Vancouver. We didn't really see those like 3,000 a foot projects in Toronto like you saw in Van, but you did still see some, I think your average or like median, your commodity condo was trading higher than Van.
Yeah, and like Montreal is, let's keep heading east. Montreal, as usual, always a value play there. Cheaper Class A, cheaper industrial, cheaper condos. Montreal consistently comes in at or kind of below the Calgary and Edmonton threshold, and of course, well below Toronto and Vancouver.
And then you've got a couple smaller markets in Atlantic Canada that they track as well. Halifax and St. John's are generally the cheapest, but the data obviously gets thinner, so it's harder to track. But a condo up to 12 stories in Halifax is $260 to $346. In St. John's, that'd be $260 to $360. I don't even know if they're really doing that much of that stuff out there, but Halifax, yes, but St. John's, I don't know. But availability of trades and materials can be more variable in those markets. I mean, you had a guy, I think, who was doing some MLI projects out there, and he was bringing trades in from Toronto, I believe. No?
Yeah. I mean, it's one of those things you can build for, like the land acquisition is obviously cheaper out there, but materials are just as expensive, in some cases more expensive, and labor, it comes down to an availability issue, right? So yeah, sometimes you gotta fly the guys in. One thing before we move on from this piece here, Dane, and this has kind of come up and has been coming up a couple times more recently on the show, and you and I have been talking about this for years. Seniors housing, these are numbers that are worth flagging too. And given what we talked about in that CBRE episode that we did, the independent and supportive living residents, so let's call them seniors homes, run about 330 to 430 in Vancouver, 270 to 370 in Calgary, 265 to 365 in Winnipeg, 250 to 385 in the GTA, and about 225 to 340 in Montreal. Now, given the demographic tailwinds that we've discussed multiple times with the boomers retiring and the silver tsunami and all that kind of stuff, those numbers really matter for anyone looking in that space. Like, can you profit? Now, those are pretty good numbers to build what you need to build. The issue with seniors housing, and we'll talk about this in other episodes, is, of course, the management and the running of it, right? Yes, you can build them, but are they profitable as a business? So speaking of that, Dan, that kind of takes us to the next segment here, which is the labor story.
Yeah. And maybe before we jump fully into the labor, I just want to observe the thing that there are separate pages for private sector and public sector, and all of the public sector costs are like substantially larger for sort of comparable buildings. Yeah. So I mean, it's just funny to see it observed in data, like how much more difficult how much more the public sector pays for construction than
surprised
anywhere
by
else.
yeah. Is
Yeah, we'll
anyone
talk a
really
little bit about
surprised
that
by
on
that?
infrastructure. Yeah, well, no, but it's just funny to see it empirically verifiable with data. I'm a data guy, so it's like, it's easy for people to just say things are the way that they are, but when numbers and math tell us it's a lot more
Don't
difficult
lie.
to. Yeah,
Yeah.
yeah. What is it? What men lie, women lie, numbers don't. Is that the quote? Is that
So I
Lil
moved out of
Wayne?
my condo and into the bank vault. Yeah,
There you go.
that's it.
And you can't talk about construction costs without really discussing the labor stuff. We had this skilled trade shortage. You had the labor. We had the government import huge temporary foreign worker population to deal with. What they felt was emergency levels of labor shortages, and this is still becoming the defining constraint of the industry. Buildforce Canada estimates the construction sector needs 85,000 additional workers by 2030 to meet demand and replace retirees. And the shortage is expected to grow 13% annually between 2026 and 2045.
Yeah, look, and this is flagged in the report directly, and we've been waving that flag too. Skilled trade shortages across things like, pretty required things for building, carpentry, electrical, plumbing, HVAC, and the finishing trades. They're compounding the pressure, right? They're driving wage inflation, pushing up project costs, causing schedule delays in a lot of markets across a lot of different projects because in a lot of cases there simply aren't enough of them. Now, right now, that might be a different story as we witness, a major pullback in some projects, but this problem exists now and it's only going to get worse.
And the demographic time bomb, like you mentioned, the silver tsunami, the share of construction workers over 55 is at a record high. And that's not going to get better because people age. That's how time works. These are your experienced tradespeople, right? The foremen, the journeymen, the ones who are handing their skills down to the next generation through apprenticeships, and they're aging out. And at the same time, we have reduced immigration targets. We have fewer and fewer people wanting to get into the skilled trades, which is a shame in my perspective, because I think not only is it one of the most meaningful ways that you can contribute to society. It's great work. You get to stay in great shape. And also,
Do you want to be rich?
yeah, and also, yeah, like you've seen those the like TikTok videos of like it's like some guy wiping his face with or like crying and wiping his tears with like a wad of cash, and it's like Toronto plumbers or something like that. Anyway, the other piece is that it's also, if you're thinking about being a young person and feeling at risk of AI replacing your jobs, it's also one of the most defensible industries against at least generative AI and computer-based AI, like agentic AI. I think it's going to be a lot longer for robots to disrupt this industry that in the same way that ChatGPT or Claude has with what you and I do, Nick. Like I think underwriting or like me
We're
doing
screwed.
home
Yeah.
evaluations, not even screwed, but like I can see it. Like I was presenting to a group of real estate professionals the other day. I'll see if I can pull the chart up actually, but something like 41%. McKinsey estimates. Let me just find it here, but it was 41% of the real estate workflow can be done by, or it says work hours requiring only non-physical capabilities, right? So they have like these things that are sort of work hours that are automatable. So work hours requiring physical and non-physical capabilities that are automatable are 13%. 34% of the real estate, and I'm just thinking realtors because like everybody who's listening to the show has probably interacted with them and whatever, what the job looks like. 34% not automatable, 41% work hours requiring only non-physical capabilities that are automatable. That's our industry. If you take this cross section and try and put it over like plumbers or anybody who's working on site, pretty much that looks very different. So that's the other thing that I think the need for skilled trade workers hasn't gone away.
Yeah, and I mean, look, it's just going to get worse and worse by 2045, and these numbers seem a bit light, but like tens of thousands, we're going to be short tens of thousands of workers. That's going to add an estimated cost of almost $8 billion to things like residential construction, renovations, repairs. It's going to increase prices, and that's why you're seeing timelines increase too, right? A project that would have taken, let's say, 12 months could now take 16, 30 months to 5 years could now take, a lot more than that, right? So the direct implication on things like carrying costs, financing, return on equity, and all the stuff that are important to, making these projects pencil. Now, Dan, before we get out of here, I want to talk about the infrastructure piece. This is that huge number that we've referenced, that $343 billion and counting. So let's shift from the construction side to the infrastructure side here, because Look, well, the private development side is for, let's say, overall, it's hard to paint it with one stroke because we know people that are killing it right now, but let's say overall struggling right now with feasibility and whatnot. The public infrastructure pipeline at least seems, or at least we're told, is absolutely massive. And that is a very good thing. This is the kind of stuff we need in this country.
Renew Canada's 2026 top 100 infrastructure projects reports totals $343 billion. That's $43 billion increase year over year, so massive margin. And civil construction is projected to grow nearly 30% from $32.6 billion to a record $41 billion by 2027. The most significant infrastructure construction cycle in Canadian history. This is the government, and it's a nonpartisan thing because both parties in the last election were proposing spend budgets of this size, right? Like both acknowledge that this was a necessary thing. The most significant CapEx that we've ever seen in Canadian history, right?
Yeah, hell yeah. This is what we need. This is what helps the economy get going. And look, we don't try to make these episodes Ontario focused, but unfortunately the top projects are dominated by Ontario. Actually, all of the top 8 are in the province of Ontario. The 2 biggest are nuclear, the Pickering Generation Station refurbishment, and the Darlington new nuclear power plant. Together, those 2 projects alone, over $50 billion. Crazy.
It is crazy. Yeah. It does go quite a bit beyond just nuclear, though. And I like to see that happening. I mean, go look at what happened in Germany where they started pulling away from nuclear, and now they're like electricity costs are getting insane, right? I mean, nuclear sounds scary, right? Like you have nuclear bomb and then you have nuclear power. Like I think that's why
like Chernobyl or something like that,
yeah,
right? Like,
but it's actually I think it's one of the the cleanest ways for us to possibly generate power,
and one of the safest.
Yeah, and so maybe let's run through a couple of the marquee projects that are here on the top 100 report. Renew Canada. We have it up on the screen here for anybody watching on YouTube. But you have the Peter Gilgan Mississauga Hospital, 2.8 million square feet, over 950 beds, the largest teaching hospital in Canada. You have the Volkswagen PowerCo battery plant, a $7 billion investment. Is that still happening, or did that get pulled? I feel like that one might have changed, but it was supposed to be Canada's largest EV battery facility. I feel like there's been like a bunch of drama around that. I'm not. That's like not really my scope, so I don't pay a lot of attention to batteries. But
you're not an EV. You're not driving an EV. You're driving like a big quad diesel truck, right? That's what you're driving these days.
Something like that, yeah.
Look, speaking of big trucks, transit is also another big one. 23 of the top 100 projects are rail and LRTs and subways, which is great because, frankly, the public transit across this country leaves people wanting, in just about every city we've been to. Dan complaints that the Scarborough subway extension is past the halfway point on tunneling. The Hazel McCallion line in LRT in Mississauga is well underway, and all these are just in Ontario projects. But of course, we see big projects happening in BC, Alberta, and Quebec as well.
And it is funny, like, for all the hate that we even ourselves give to the GTA and Canadian infrastructure, like, I think the GTA is the only city in North America that's actually building a subway line right now. So, I mean, we got that going for us, which is nice, I guess. But the healthcare piece, and this kind of goes more to towards that senior thing that you were mentioning earlier, a lot of industry starting to shift towards this retirement of the baby boom that we've been seeing happening. Healthcare alone accounts for 21 of the 36 vertical building projects in the top 100 on that list. Wow. St. Paul's Hospital in Vancouver, Toronto Western Surgical Tower at a $750 million value. The I guess I got to try this. You gave me the French one this time, eh?
Of course.
Hôpital de Vaudreuil-Soulanges in Quebec. There's a
well done.
I just had to pull that one out. A generational wave of hospital construction happening, which is, you hear a lot of Canadians, like, when we complain about stuff, it's like we complain about healthcare. And I mean, it is kind of scary because this is the state of Canada's healthcare system when you have 11 million people approaching the age of really needing healthcare very soon.
Man.
So there's that.
Yeah. I mean, if anyone, and I like, everyone listening has a bad healthcare story. I know I do. I'm not going to share them right now. I know you do, Dan. You're not going to share them, but everyone listening has one.
I only share those with ChatGPT.
And look, I mean, if we think it's bad now, it's going to get worse. But let's not go there, okay? This is the investor angle I want people to think about, and this is where we're going to kind of wrap the show up with the investor angle and kind of what the cost guide doesn't really tell you. All this infrastructure spending competes for the same labor pool and the same materials as private development, right? There's a lot of overlap here. So when the government is spending $343 billion on mega projects, that puts upward pressure on wages and materials across the board for everyone involved that would be involved in this or a private project. It's great for construction workers, but it makes the private sector stuff sometimes, in some cases, even more hard to pencil, right? The feasibility gets a little more difficult in some cases because you're competing.
Well, especially now knowing based on the cost guide that how much more the public sector is paying than the
Yeah,
private
I
sector.
mean,
And
who are you going to go work for, right?
I feel like I know I called this on Twitter. I don't know if I called this on the show, but that, this was very predictable that the government was going to use this to sort of keep the construction sector alive. And that would continue to put upward pressure on the cost structure of housing, therefore preventing future supply and potentially keeping the housing cost or prices propped up through just scarcity. You get to the infrastructure cost benchmarks, you get light rail underground guideway in Ontario runs 89 million to 213 million per kilometer. Underground stations 54 million to 220 million per unit. That's a big range, man. I mean, I feel like it's like 54 when they announce it, and
public,
then 222 million when it's done. Multi-lane highways are 2.5 to 4.9 million per lane kilometer. And these are when you think about this, they're like a massive, massive numbers, but they're absorbing a massive share of Canada's construction capacity, which otherwise would be going to the other things that we mentioned, like creation of large scale residential, housing.
Totally. Okay, let's close this out with some kind of investor takeaways here, right? If I'm going to distill this down for some key points for all of you to take away from this episode, the first one would be costs have kind of stabilized, but they've stabilized at that new baseline, right? So yes, they've leveled out, but they've leveled out at a higher level. So don't expect meaningful relief this year, okay? That seems to be pretty obvious. Escalation is running in line with inflation, but the base is elevated, and then you throw tariffs and other stuff on there too. That's the wild card.
Number two would be that the feasibility math is broken, and this has resulted in project failures and supply going away and record cancellations and a pipeline that is drying up. And this could set up a future supply crisis if we don't figure out another way to get that supply created, such as multiplexes or purpose-built rental, which seem to be starting to enter the discussion.
The third would be the cost gap between cities is very real and very investable if you can find it, right? Like at Calgary and Montreal, they offer meaningfully lower construction costs than Toronto and Vancouver by 15 to 25% margins. So if you're a developer or an investor, that spread really matters.
Number four, labor is the long-term constraint that nobody is solving fast enough. The industry, by their own estimates, needs 85,000 workers by 2032. That's not that far away. And the workforce is aging, and immigration policy isn't filling the gap. And it wasn't even when we had 1.4 million, population growth at peak. They weren't going into these industries. They were like, and so that will need to be fixed for us to use immigration to solve this problem in the future. And this could be a persistent cost escalator for years. And if you're a trade, you are the cost escalator that we're talking about. So have fun getting super rich.
Number five, and the last one for me, Dan, before we wrap up here, the $343 billion worth of infrastructure in the pipeline here is reshaping the construction market. This is very exciting in some ways, right? It's creating enormous demand for labor and materials. The ripple effect is going to be positive for the broader economy. But of course, there's two sides to this story, right? This also adds pressure to the private sector project costs and availability of labor and materials. As an investor, you want to be positioned near where that infrastructure is going to be spending, right? New subway line, buy a property close to that. New pipeline, buy a property close to that. New hospital, buy a property close to that, right? But understand the competition for construction and resources isn't going away anytime soon.
So bottom line, 2026, I would say knowing your construction costs isn't optional. I feel like it wasn't ever optional, but it maybe the better way to say that is it's more important now than it ever has been. I would say construction costs this year are blowing up more deals than I've ever seen. And I mean, like, think about it, dude. Like when you and I just talk about construction, like we're talking about the renovations that I've done on my house or renovations that I've done on plexes. I think that last year, like when I put a couple of basement suites in the units that we did, that was the first time I've ever had bids come in at a price that surprised me to the downside, and they delivered at or below what I had originally forecasted. I don't think I've ever had, and like
Nice.
I'm not an amazing project manager, and I try not to do it because it's not a good use of my time, and there are better people. But I have a exceptionally good contractor and construction manager who does that for me, and so I trust the outcome. But there are like, sorry, when back to the question, when you think about when you think about construction, do you ever think that it's gonna go as planned, right? Like how much do you contingency when you guys are underwriting?
Yeah,
How much you contingency,
10 to 15% bare minimum.
right?
Yeah.
So yeah, so I mean, this this episode is important because this stuff's blowing up pro formas. It's blowing up pro formas. It's blowing up deals as much as, if not more than, your CMHC. Your bond yields accelerating. I mean, yeah, they're jumping up a lot, but not to 10 to 15%. And yeah, it's like the interest rate is a huge portion of your total cost structure on a 50-year amortization on a takeout loan, but your costs are also one of the biggest things. One of the probably the whole game, if you're creating housing right now, is managing these costs on the way in. This is why we do the episodes, and this is why we want you to pay attention to them. I hope this is of value to you. If you want to learn more about this stuff specifically applied to smaller projects that people like yourself, mom and pop, I own some land, single family, trying to scale up. We do multiplex events across the country. Toronto, September 15th, Montreal sometime in November. We'll be repeating Vancouver and Alberta. We're probably going to move to Calgary in 2027. Hope to see you there. Make sure you get tickets because they do sell out. I think we've sold out every single one this year. So thanks a lot for taking the time to listen, and we'll see you again as soon as we possibly can.